You know, we all have this sort of mental picture of how government money works, right?
Like a household budget, usually.
Exactly. Money comes in taxes and then it goes out for, road schools, all that stuff.
Yeah.
But what if that basic idea that the government needs our tax money before it can spend? What if that's just, well, wrong?
That's really the crux of it, isn't it? And it's kind of mind-bending when you first encounter it.
It really is. And that's what we're diving into today.
Yeah, we're looking at the operational realities, the actual nuts and bolts of how the Treasury and the central bank, like the Fed in the U.S., interact every single day.
We're talking about bank reserves, right? These sort of digital accounts banks hold at the Fed.
Precisely. Think of them like the bank's own checking accounts at the central bank. It's not, stacks of cash somewhere. It's electronic.
Okay, so our mission today is to unpack how government spending actually happens, how taxes work in this system, and what those government bonds are really for. We've got some material that honestly might surprise you.
It definitely challenges the conventional story.
So are you ready to maybe rethink how this whole system operates?
Let's do it. Maybe start with an example. Say the government wants to buy a bunch of electric school buses. Good policy, right?
Sure, yeah. So
Uh-huh.
how does the bus company actually get paid?
Okay, so the government, the Treasury, tells the Fed, pay School Bus Inc. The Fed then basically just credits the reserve account of the bank where School Bus Inc. does its business.
Just like that, a keyboard entry.
Pretty much, yeah. A digital entry increases the reserves for that commercial bank at the Fed. And at the same exact moment, School Bus Inc. looks at its account at its bank and sees the balance go up. Cha-ching.
Wow. Okay, so the money, or the reserves rather, just appears.
It's created in that moment, yes.
Yeah.
The key thing here is government spending injects reserves into the banking system. It adds them.
Right. Adds them. Okay, so what about the other side? When I pay my taxes, which I definitely do.
Huh, good to hear. Well, you see your bank account go down, obviously.
Painfully, yes.
And behind the scenes, your bank's reserve account at the Fed also goes down by that amount.
And where does it go? Does it just vanish?
No, it shifts over to the government's account, the Treasury's account, which is also held at the Fed. So taxes do the opposite of spending. They drain reserves from the banking system.
Okay, spending adds, taxes drain. Got it.
And this constant adding and draining, this sort of inflow and outflow, creates what we can call the reserve effect. It's like, imagine pouring water in and draining water out of a bucket constantly. The level is always changing.
And that changing level matters.
Hugely. Because if the level of reserve swings wildly, it can make the overnight interest rate, that's the rate banks charge each other to borrow reserves, go haywire. Like a caffeinated kangaroo bouncing all over the place. You need stability.
Right, you don't want kangaroos bouncing around the banking system, so how do they manage that?
Well, one key tool involves something called tax and loan accounts, T&L accounts.
Okay, I've heard of those, but they always seemed a bit obscure. What's the deal?
They're basically temporary holding accounts for government funds, but they're held at commercial banks, not initially at the Fed.
Ah, okay. So when I pay my taxes, the money might first go into one of these T&L accounts at my bank or another commercial bank.
Exactly. Or when the government sells bonds, the initial payment might land in a T&L account too. And the really clever part is, when the money goes into a T&L account, the reserves don't actually leave the banking system yet.
Oh, I see. They just move from, say, my bank's reserve account to the reserve account of the bank holding the Treasury's T&L deposit.
Precisely. The total level of reserves within the commercial banking system stays the same at that initial point. It's like shuffling money between different pockets within the same pair of trousers.
So these T&L accounts act like a buffer, a shock absorber.
That's a great way to put it. They prevent these huge sudden drains of reserves every time taxes are collected or bonds are sold. It avoids that kind of financial whiplash.
So the Treasury is sort of strategically parking the funds.
Yeah, they manage the timing. Then, when the Treasury actually needs to spend the money, pay for those school buses, for example,
Right.
it moves the necessary funds from these T&L accounts at the commercial banks over to its main account at the Fed.
It sounds like a bit of a coordination effort, a financial ballet, almost.
It really is, all aimed at keeping those reserve levels relatively stable day to day.
Mm.
Stephanie Bell, who's now Stephanie Kelton, did some really important work highlighting just how crucial this backstage operation is.
Okay, that makes sense. Now,
Vaughn.
government bonds. The standard story is the government spends more than it taxes, runs a deficit, so it has to borrow money by selling bonds.
Right.
That's the story everyone knows. But based on what we've just talked about, let's rethink it.
Okay.
When the government does run A deficit spends more than it taxes. What happens to the overall level of reserves in the banking system? We said spending adds and taxing drains.
So, a deficit means there's a net add of reserves, more going in than coming out. Exactly. Over time, a deficit leads to an increase in the total reserves held by banks. Now, what happens if banks are just sitting on piles and piles of these extra reserves, maybe not earning much interest on them at the Fed?
Well, if they have lots of something they don't necessarily need, they wouldn't pay much to borrow more of it from other banks, I guess. So the overnight interest rate would fall.
Precisely. It could get pushed down really low, maybe even towards zero, which might not where the central bank wants it to be.
Ah, okay. So are you saying bonds are sold to mop up those excess reserves?
That's the perspective here, yes. When the government sells bonds, banks, or individuals or companies buy them. To pay for the bonds, reserves move out of the buyer's bank account, ultimately draining reserves from the banking system and into the Treasury's account at the Fed. Or sometimes it's an exchange where the Fed sells bonds it already holds. Either way, it drains reserves.
So instead of borrowing to spend, it's more like offering an interest-bearing alternative to excess reserves.
That's a really good way to frame it. The bonds give banks a place to park those extra reserves that the government's deficit spending created, allowing them to earn some interest. And this action supports the central bank's interest rate target. It helps keep the rate from falling too low due to all those excess reserves sloshing around.
So the purpose isn't really funding the spending itself?
Operationally, no. It's about managing the consequences of the spending on the level of reserves and the overnight interest rate. It helps maintain interest rate stability.
Wow. Okay. Warren Mosler called the national debt an interest rate maintenance account, or IRMA. That makes a lot more sense in this context.
It fits this operational view perfectly, doesn't it? It's a tool for managing liquidity and supporting the Fed's interest rate policy.
Which brings us neatly to the Fed, the central bank. What's its main job in all this? Is it controlling the money supply, like in the old textbooks?
Well, that old money multiplier story has largely been superseded. In practice, especially for countries like the US, the UK, Japan, the central bank's primary day-to-day focus is setting a target for that key overnight interest rate.
Like being the interest rate DJ, setting the tempo for the cost of money between banks?
That's a fun analogy.
Hmm.
Yeah, they pick a target rate, the federal funds rate target in the US, and then they use their tools to nudge the actual market rate towards that target.
And what are those tools, primarily?
If the actual rate is drifting too high, meaning reserves are maybe a bit too scarce, the Fed can inject reserves. A common way is buying government bonds from the banks, the opposite of the Treasury, selling new ones. That pushes reserves into the bank's accounts.
Okay, easing the pressure. And if the rate is too low, too many reserves.
They can drain reserves, maybe by selling bonds to the banks. But increasingly, a key tool is interest on reserves, or IOR. The Fed can simply pay banks interest on the reserves they keep parked at the Fed.
Ah, so if banks can earn a decent risk-free rate just by leaving reserves at the Fed, they won't lend them out to other banks for less than that. It sets a floor.
Exactly. It helps keep the overnight rate from falling below the rate the Fed pays on reserves.
So the Fed is steering the price of reserves, the interest rate, not really the quantity of money circulating out here in the economy.
Right. The broader money supply, the stuff in our bank accounts, is mostly determined by banks making loans to creditworthy households and businesses who want to borrow. It's largely demand-driven or endogenous, as economists say.
Okay, this is all building towards something, I feel.
It is, because now we hit the really big reveal, the most, perhaps, counterintuitive piece.
Lay out on me.
Spending comes first.
Wait, say that again?
Government spending has to happen before taxes can be paid or bonds can be bought.
But how? We're so used to thinking, get money, then spend money.
Think about it logically. If the government needs our dollars issued by the government itself, to pay taxes or buy its bonds, where do we get those dollars from in the very first place? The government, as the issuer of the currency, must spend or lend them into existence first. It has to inject those base reserves, that high-powered money we talked about, into the system before it can possibly collect them back in taxes or swap them for bonds.
So the government is like the scorekeeper at a baseball game. It has to put the points on the board before anyone can have points.
That's another good analogy.
Yeah.
It has to provide the units of account first. The act of spending is the initial creation, the injection of those reserves.
This flips everything on its head. So taxes and bonds aren't funding the spending.
They're managing the consequences. Taxes remove reserves, destroying that high-powered money, which helps manage inflation and demand. Bond sales swap reserves for bonds, managing interest rates. But the spending itself is the origin point.
Again, you mentioned Stephanie Kelton and Warren Mosler. They really drove this point home.
Absolutely. Their work on these operational realities has been fundamental to understanding this sequence.
Hmm.
Spending first, then taxing or issuing bonds to manage the effects.
So when a sovereign government that issues its own currency spends, it's essentially always spending new money into existence first.
In a very real operational sense, yes. That spending is financed by the creation of new reserves, new central bank money. The taxes and bonds come after, operationally speaking.
Wow, that changes how you think about deficits and debt, doesn't it?
It really does. The constraints aren't what we typically think they are. They're not primarily financial in the sense of needing to get money first.
Okay, let's try and recap this. This has been a lot, but really fascinating. What are the absolute must-remember points?
Okay, let's break it down. Four main things, maybe.
Go for it. One.
One, government spending injects reserves into the banking system. Taxes drain them. This reserve effect is happening constantly and needs careful management.
Okay. Inject, drain, manage. Got it. Two.
Two, the Treasury uses tools like those tax and loan accounts, the T&L accounts at commercial banks. They're crucial shock absorbers, smoothing out fund flows and helping stabilize reserve levels. That backstage ballet.
Right, the ballet. Stabilizing reserves. Three.
Three, government bonds. For a currency-issuing government like the U.S., aren't primarily about funding the government. Their main operational purpose is draining excess reserves created by deficit spending to help the central bank hit its interest rate target. Think interest rate maintenance account.
Not funding, but reserve management for interest rates.
Okay.
And the big one. Four.
Four, spending comes first. Logically, operationally, the government must spend its currency into existence before that currency can be used by us to pay taxes or buy bonds.
Spending first.
Yeah.
Creates the dollars. Wow.
Yeah, those 4 points really capture the essence of this operational perspective.
So, feeling a bit more enlightened about the engine room of government finance? Or maybe your head's spinning a little?
It can definitely take a while to sink in. It challenges deeply held assumptions.
It absolutely does. And it raises a huge question, doesn't it? If the government doesn't need to tax or borrow before it spends, what actually limits its spending? What are the real constraints?
That is the critical next question. It's not about running out of money, it creates itself. The constraints are elsewhere.
And that leads perfectly into our next deep dive. We'll be tackling the nature of fiat currency and sovereign spending. What even is money when it's not backed by gold? And what does this idea of monetary sovereignty really mean for a government?
Yeah, what power does that sovereignty give a government, and what are its true limitations? Things like real resources, inflation.
It's going to be another epic exploration digging into the very foundations of money and government power in the modern world.
Looking forward to it. It builds directly on everything we've discussed today.
Absolutely. Until then, keep those operational realities in mind. This has been The Deep Dive.
Don't let your reserves get too low.